Hi, this is Brian from KineticTrader.com, and I wanted to follow up on a second installment here on Fibonacci trading. And you can keep it pretty simple. Generally, the Fibonacci, as I mentioned in the last video, is very good at just identifying potential support areas on a major trend. You can use it short-term charts with even down to 1 or 2 minute charts, all the way up to longer term charts. The last video I showed was Apple, how it made this long move and trying to see if it was going to hold support on a retracement. And if you just go down, and this is sink or swim, you draw the major support bounce to the top. That's the major trend. And then you look at the most recent support trend. So this was the swing low. As it broke through this high and started making the run, this became the new active low here. So you just draw another support here. And what you do is you look at the comparison between the major support areas for Fibonacci retracements and the most recent run and see if there's any overlapping retracement levels to give an idea of where stronger support should be. So on the shorter run, it was 50% here, overlapped with the 38% retracement of the entire move. That should have been decent support. It did make a little bounce, but then it continued to weaken. And the next level here was the 62% right here of the shorter term trend and the 50% of the major trend. And as it broke through there, that was an indication that probably the trend is changing and that we probably won't see much of a bounce, if any, and look for it to retrace this whole move here and potentially the entire longer term move. So now that we've known that it's already in a defined downtrend, now you can look at seeing where, if you were going to go short on the stock or be negative, where it would bounce up to. So you draw from the top. Let's highlight Fibonacci levels. And you draw it down, and you just wait till you see a good bounce level. After it's already broken the uptrend, now you're looking for a sign of support. And you did see a major reversal candle down there. And generally, as I mentioned, I usually just look at the 38%, the 50%, and the 62% as the major retracement levels. Those are the most popular, so might as well use what's most popular. And it becomes kind of a self-fulfilling price level that most people watch. And for the major move, you can see usually if the trend's going to continue to be weak and continue downward, you will start seeing it reverse here at the 38%, potentially all the way up to the 50%. But what you can also do is on the first bounce up here, the most recent bounce, you can draw again a minor move retracement and see if there's any overlapping to give you a little more confidence. And as you can see, generally on a recent move, you will see on the major moves, if you see it hold in this 38 to 50%, that would be a potential area that you could have shorted to see if the trend continues back down, and keeping your stops just above those levels where the most recent support resistance. So you could have put it right above the 50% and it just had an open order to short when it got up to these levels on this bounce up here. And as you can see, it exactly hit the 62% on the most recent move, and you generally will see a bounce in the 38 to 50%. Right in the middle there is pretty common area on the more recent major move. So as you can see, that was a great area to short. You can look for a certain, maybe a price pattern that's showing a weakness or a top, but you could have had a reasonable risk to reward in these levels if you were to look to short on this bounce from the lows to the high. And just want to point that out as a follow-up to the last one. If you have any questions, you can visit KineticTrader.com. Thank you.